From the time we are old enough to understand words, we are sold a very specific, deeply ingrained equation. It is taught in schools, echoed by our parents, and reinforced by almost every piece of media we consume. That equation is simple. Work hard, get good grades, get a safe job, put in the grueling hours, and eventually, if you just grind long enough, you will be wealthy. We are conditioned from childhood to believe that sweat, exhaustion, and relentless physical or mental hustle are the ultimate and only currencies of true success. Society glorifies the grind. We actively celebrate the person pulling 80-hour work weeks, the person sacrificing sleep, missing family events, and climbing the corporate ladder rung by exhausting rung. We treat burnout as a badge of honor, a necessary toll on the highway to financial freedom. But there is a massive, glaring flaw in this logic. If hard work alone was the definitive, guaranteed secret to wealth, then every construction worker breaking their back in the summer heat, every nurse working exhausting double shifts in the emergency room, and every single mother working 3 minimum wage jobs just to keep the lights on would be a multimillionaire. They are the hardest working people in our society. Yet they are usually the ones struggling the most financially. They aren't wealthy. The uncomfortable truth that the middle class is never taught is this: time and labor are finite resources. They are strictly limited. You only have 24 hours in a day. Even if you completely forego sleep, ignore your health, and never take a moment to rest, you have a hard, mathematical limit on how much you can physically or mentally produce with your own 2 hands. If your underlying strategy for building wealth relies solely on trading your literal hours for a literal paycheck, you have already hit a permanent ceiling before you even begin. You're playing a game where the rules dictate that you can never truly win. Enter Warren Buffett, a man worth well over $100 billion. He doesn't lay bricks. He doesn't write code for 14 hours a day. He doesn't run from stressful meeting to stressful meeting, yelling into a phone. In fact, by his own frequent admission, he spends about 80% of his day just sitting quietly in his office reading books, newspapers, and corporate financial reports. He drinks cherry Coke, eats McDonald's, and thinks. So, how did a man who spends the vast majority of his life sitting in a comfortable chair become one of the wealthiest humans in modern history? To understand Buffett, and to understand the reality of wealth generation, we have to completely dismantle the illusion of hard work and explore the actual framework he used to build his massive empire. This is not about getting rich quick, and it is certainly not a justification for being lazy. It is about a complete, fundamental rewiring of how you view time, money, and most importantly, leverage. Let us step back and look at the basic math of human labor and income. The traditional working model that most of the world operates on is perfectly linear. You work 1 hour, you get paid for 1 hour. You work a salary, you get paid a fixed amount for a year of your life. Let us say you work incredibly hard. You take on massive amounts of student debt, you study for a decade, and you become a highly paid corporate lawyer or a specialized neurosurgeon making a fantastic hourly rate or a massive salary. You might feel rich. You can buy a nice house and a luxury car, but you are still entirely trapped in the linear equation. If you sleep, you make $0. If you get sick and cannot operate or go to court, you make $0. If you decide to go on a month-long vacation to recharge, your income essentially pauses. You are the sole engine of your financial life. And when the engine stops running, the car immediately stops moving. You have a high-paying job, but you do not have true wealth because your wealth is inextricably tied to your ongoing labor. Buffett realized something fundamental very early in his life. Wealth is not generated by the sheer amount of physical or mental effort you exert, but by the efficiency of how you allocate capital. Wealth isn't about maximizing your labor. It is about permanently decoupling your time from your income. This is achieved through owning equity. Equity means owning assets that produce value completely independently of your physical presence or daily effort. When you own a piece of a profitable business, you are essentially buying the collective hard work of thousands of other people. If you own shares in a massive consumer goods company, or a tech giant, or a railroad, there are factories churning out products at 3 in the morning while you are deep in REM sleep. There are brilliant marketing teams designing global campaigns, logistics experts moving fleets of trucks across the country, and thousands of dedicated employees working incredibly hard every single day to increase the value of the asset that you own. You are not doing the labor. You are not stressing over the supply chain, but you are legally entitled to participate in the profit. Hard work builds character. Hard work builds the initial seed money you need to get into the game. But leverage, specifically financial leverage through ownership and equity, is what actually builds generational wealth. To understand this, we need to look at Buffett's origin story. It is a mistake to think Buffett never worked hard. As a child and a teenager, he was the ultimate hustler. He delivered thousands of newspapers, waking up before dawn. He bought a used pinball machine, placed it in a local barber shop, and then used the profits to buy more pinball machines until he had a small empire of them across town. He sold chewing gum and Coca-Cola door to door. He worked incredibly hard. But the key difference between Buffett and everyone else is what he did with the money he earned from that hard work. Most people take the money they earn from their labor and use it to buy liabilities, things that lose value over time, like expensive clothes, depreciating cars, or bigger houses that require more maintenance and higher taxes. This is called lifestyle inflation. As their hard work yields more money, their expenses rise to match it, keeping them permanently trapped on the treadmill. Buffett took the money from his paper routes and his pinball machines and immediately converted it into assets. He bought farmland. He bought stocks. He understood that his own physical labor was just the starter motor designed to get the real engine running. Once the real engine, his investments, was running, he could step back. He traded the hustle of physical labor for the intellectual pursuit of capital allocation. If Buffett isn't working hard in the traditional sense, what exactly is he doing in that office in Omaha all day? He is acting as a master capital allocator. Think of it like this. Imagine you are a 5-star general in a vast, sprawling army. But your soldiers are not human beings. Your soldiers are dollar bills. Your job as a general is not to go to the muddy front lines, grab a sword, and fight hand-to-hand with the enemy. That would be an incredibly inefficient and dangerous use of your position. If the general falls, the army falls. Your job is to sit in the command tent, analyze the entire global battlefield, and deploy your dollar bill soldiers to the exact strategic locations where they have the absolute highest probability of winning, conquering territory, and capturing more soldiers to bring back to you. Buffett spends his time analyzing businesses. He looks deeply into corporate financial reports. He isn't just glancing at stock tickers and red and green arrows on a glowing screen. He is studying the fundamental, underlying economics of the businesses those stocks represent. He is obsessed with finding companies that have an enduring competitive advantage, what he famously calls a moat. A moat is something that protects a business from its competitors. It could be a powerful brand name, like Coca-Cola or Apple. It could be a massive cost advantage, like Costco. Or it could be switching costs, where it is simply too painful for a customer to leave, like a dominant software ecosystem. When Buffett buys a company, he looks for a business that requires very little ongoing capital to maintain and grow, meaning it consistently throws off massive amounts of free cash flow. A classic textbook example is his purchase of See's Candies in the early 1970s. It was a beloved, premium brand that commanded immense loyalty. It didn't need to spend billions of dollars building new, high-tech factories every year to make a profit. It just generated pure cash, year after year, predictably and reliably. Buffett took that cash, the literal hard work and profits of See's candies, and deployed it into other investments. This is the magic trick. He bought insurance companies, most notably Geico. Now, the insurance business is arguably the greatest wealth-building mechanism ever devised when run correctly, because of a concept called float. When you pay your car insurance premium every month, the insurance company takes that money and holds on to it. They only have to pay it out if you get into an accident. In the meantime, they have billions of dollars of other people's money just sitting there. This is the float. Buffett realized that he could use this float, money that didn't even belong to him, money that cost him 0% interest, to invest in even more businesses. He used the hard work of candy makers to buy an insurance company, and then used the premiums paid by ordinary drivers to buy stakes in the largest banks, railroads, and consumer brands on Earth. He built a self-sustaining ecosystem of wealth generation that requires zero physical labor from him to operate. You might be thinking, this is great for a billionaire, but how does this apply to me? I don't have the money to buy a candy company or an insurance conglomerate. The beauty of the public stock market is that you do not need $1 billion or even $1 million to adopt this exact mindset and strategy. The psychological shift happens the moment you stop thinking of yourself purely as a laborer, as someone who just clocks in and clocks out, and start thinking of yourself as a capital allocator. Even if you are just taking $10, $20, or $50 a week out of your paycheck and putting it into a broad, low-cost S&P 500 index fund, you are fundamentally doing exactly what Warren Buffett does on a smaller scale. You are buying fractional ownership in the 500 largest, most profitable companies in the United States. You are taking a tiny slice of the fruits of your own labor and sending those dollars out into the global economy to work for you. You are hiring the best CEOs in the world, the brightest engineers, the most ruthless marketing executives, and millions of frontline workers to wake up every day and make you richer. And they do this without you ever having to attend a single board meeting, answer a single email, or lift a single finger. But to make this work, we must talk about the absolute, undeniable engine of Buffett's wealth: compound interest. This is the concept that the human brain is biologically ill-equipped to understand. We are wired to think linearly. If we take 1 step, we move 1 meter. If we take 30 steps, we move 30 meters. But compounding is exponential growth. If you take 30 exponential steps, where each step doubles the distance of the last, you do not travel 30 meters. You travel to the moon and back. There is a staggering, almost unbelievable statistic about Warren Buffett that completely reorients how we should think about getting rich, and it is a fact that should be taught in every school in the world. Over 90% of Warren Buffett's immense net worth, a fortune measured in the hundreds of billions, was accumulated after his 65th birthday. Let that profound fact sink in for a moment. Over 90% of his wealth came after the traditional age of retirement. This wasn't because he suddenly figured out a secret algorithmic trading strategy in his senior years. It certainly wasn't because he started working harder, sleeping less, or hustling more in his 70s and 80s. It was purely because the snowball he started rolling when he bought his very first stock at age 11 had finally gained massive, unstoppable, exponential momentum. Hard work tells you to constantly push a massive, heavy boulder up a steep, unforgiving hill. You sweat, you bleed, you strain every muscle, and if you stop pushing for even a second, if you get sick, or if you lose your job, the boulder rolls all the way back down to the bottom, and you have to start over from nothing. Compounding tells you a completely different story. Compounding tells you to pack a tight, dense snowball, find a very long, snow-covered hill, give it a gentle push, and then just step back and let gravity and mathematics do the work. The hill is the timeline of your life. The snow is the global economy, the stock market, real estate, or a private business you own. Your only real job, your only true responsibility once the snowball is rolling, is to protect it and carefully ensure you do not interrupt the compounding process. Most people fail entirely at compounding because they lack the one trait that Buffett possesses in abundance: patience. Human beings want the wealth right now. We are driven by instant gratification. We want the luxury car today, the massive house tomorrow, the validation of our peers immediately. Because of this impatience, the average investor constantly trades in and out of stocks. They try to time the market, buying when things are euphoric and panic selling when the market crashes. They jump blindly from one trendy, hyped-up investment to another, from meme stocks to obscure cryptocurrencies to whatever the current financial fad happens to be. Every time they trade, they pay taxes. They pay fees to brokers. They realize losses. By constantly interrupting the compounding process, they are effectively taking a blowtorch to their snowball just as it starts to gather meaningful size. Buffett's ultimate secret weapon is deliberate, calculated inaction. He buys phenomenal assets at fair prices, and then he does the absolute hardest thing of all for human psychology to endure. He does absolutely nothing. He sits, he reads, he waits. He lets the unstoppable math of compounding work its magic over decades. He famously said that the stock market is simply a device for transferring money from the impatient to the patient. So, if the secret to immense wealth is just buying good assets and letting them compound over time, why do so many highly intelligent, fiercely hard-working people consistently lose their life savings in the financial markets? The answer lies in arrogance. People consistently confuse general intelligence with specific financial competence. Buffett operates on a very strict, unbreakable philosophical rule. He only ever invests within what he calls his Circle of Competence. Imagine a circle drawn on a piece of paper. Inside that circle are the things you deeply, truly understand. Outside the circle is everything else in the universe. You do not need to understand complex synthetic derivatives, the underlying cryptographic algorithms of the latest blockchain protocol, or the incredibly dense medical science behind a new biotech startup. If that is not your specific field of expertise, you do not need to understand every industry to be wildly successful. You just need to know exactly where the boundary of your understanding ends. For decades, Buffett famously and stubbornly avoided investing in the vast majority of technology stocks. During the massive dot-com bubble of the late 1990s, when everyone with a pulse was making paper millions on internet companies that had never turned a single dollar of profit, Wall Street actively mocked Warren Buffett. They called him a dinosaur. Magazines ran headlines saying he had lost his magic touch, that the world had passed him by, and that his value investing philosophy was dead. But Buffett simply shrugged. He calmly stated that he did not fundamentally understand how these new internet companies were going to make consistent, predictable cash flow over the next 20 years. He couldn't predict their future economics, so he simply passed. He refused to let the fear of missing out dictate his actions. When the bubble inevitably burst in the early 2000s and trillions of dollars of paper wealth were violently wiped out, destroying the portfolios of millions of hard-working day traders, Buffett's portfolio remained utterly secure. He had stuck to banking, insurance, and consumer goods, businesses that sell products people buy every single day, businesses he could easily and completely wrap his head around. The physical size of your circle of competence is not nearly as important as knowing exactly where the perimeter is drawn. The greatest actual risk to your financial well-being is not market volatility, recessions, or inflation. It is ignorance masquerading as knowledge. To get rich and stay rich, you do not need to be a visionary genius who is right about every macroeconomic trend. You do not need to predict the future. You just need to be consistently, predictably right about a few specific things that you deeply understand and avoid making catastrophic mistakes in areas you don't. Work hard on expanding your knowledge. Read books constantly, study history, understand human psychology, but never, ever risk your capital outside the strict boundary of what you truly grasp. If we look at the overarching philosophy of wealth, we realize that hard work is merely the entry fee. It is the prerequisite for basic survival in the modern world. Without hard work, discipline, and focus, you cannot possibly build the initial capital you need to get your snowball started. You have to put in the grueling hours at the beginning of your journey. You have to save aggressively, live below your means, and generate surplus cash. But if you want true, lasting financial freedom, the kind of absolute freedom where your time belongs entirely to you, where you can wake up every morning and do exactly what you want to do, with whoever you want to do it with, for as long as you want, you must evolve past the mindset of a laborer. You must execute a fundamental transition. You must move from trading your precious, irreplaceable time for money to trading your money for assets. You must learn to read the language of business, understand the financial metrics that actually matter, and eventually let time and the mathematical miracle of compounding do the heavy lifting for you. Warren Buffett didn't build a massive historic fortune by putting his head down and running faster and harder than everyone else on the corporate hamster wheel. He built his empire by stepping off the wheel entirely, quietly observing how the machine actually works from the outside, accumulating capital, and eventually just buying the whole cage. The system is designed to keep you working. It is designed to keep you tired, consuming, and reliant on the next paycheck. Stop trying to blindly outwork a system that is rigged against linear labor and start learning how to own a piece of it instead.